Hello and welcome to NDTV Profit. You're joining us in this special broadcast where we're discussing Pine Labs' new IPO that's going to come up on the 7th of November. It's going to remain open till the 11th of November. The company is looking to raise roughly 3,900 crore. This includes a fresh issue as well as an OFS component. I have with me Amrish Rao, the MD and CEO of the company. Amrish, welcome to this conversation. I wanted to start with the 3,900 crore number. Since this morning, I've been reading a lot of articles about how it has been cut sharply from what was originally planned a few months ago, the number that was floating around in the market. If you can just tell us, tell our viewers about that, and then I'll come to the valuation question because that's a separate one.
Maybe I'll combine both those questions. See, look, the top 5 Indian banks are clients of Pine Labs. The top 5 retailers are all clients of Pine Labs. The top 3 Q-commerce company, the top 3 online companies, all are clients of Pine Labs. And that happens not just because we have built great products, but also in general, the community believes that this is a good company and these are nice sets of people. If you go to Bangalore, you go to Delhi, one thing that you will always get to hear from the investor community as well as the founder community there is that these are good people, these are people that we like to be associated with. When we are going out to IPO, we didn't want to forget that. We believe that it takes a village to take a company to IPO, and now at this stage, we want to take everybody along as we go forward. It's very important that you price the IPO in such a way that you can take the community, you can take the village along with you. And that's exactly how we have gone ahead and priced our product, priced our IPO. Now at the same time, right at the start of this whole process, what we did was we kept an enabling number on the OFS that our investors would want to do. Our investors believe that they would want to continue to hold on. And what we have done is we have reduced the OFS size significantly because our investors did not want to sell it at that price that we have decided on, because we also wanted to bring the community along with us as we go forward. I have to tell you this, I've got a Gujarati in-law, and my father-in-law actually called me up and said, great pricing. So I have to tell you this, that we have tried to take everybody along when it comes to pricing.
So how much share, basically?
How much share.
Okay, great. So 210 to 221, that's the price band that you're talking about. And at the upper end, it's about 25,377 crore. That's the number that I read and I found out. This is still lower than what the market was pegging you earlier, close to about $5 billion. This is close to 2.88 billion. Is there a reason for that? I mean, yes, I understand your point about you want to cut the OFS size, but from a shareholder perspective, when they're looking into the company to buy into it, a sharp cut right at the IPO, does that cause any concern for them?
Again, the exact same principles that we've gone with. We said that we should make it very easy for people to participate and join us in that IPO. And this has been a philosophy of the company right through the times that we have built this great company. In fact, one of the things which I'll point out to you is if you actually look at our shareholder base, in our shareholder base, we have some great founders which actually joined us on the journey. One of the clear philosophies that we've had for so many years is if you bring the community along with you, I think you're in a much better place. When you price the product in a certain levels, it makes it very easy for new investors to come in and join you on the journey. And that has been a principle on our side. In terms of the speculation about what the pricing could have been, I don't know if you're suggesting I should have been 20% higher. That's not the topic. I think I just want to get everybody along and take them and move forward.
Okay, fair enough. Because the argument has always been that tech companies tend to command a very high premium, and there's not much left for the investor to make money.
We don't want to be lonely. We want to be friendly and take everybody along.
That's a great answer. Okay, let me come to the company itself. Now, in a world of fintechs, you're mostly tech fin, actually, with the tech being the forward. And the fin is just the business area you operate in, right? But going ahead, as you are raising this kind of money, 2,080 crore that you're raising from the market, a part of it, 530 crore, I think, is for debt replacement, repayment, and the rest is into future growth. What exactly are you seeing in terms of that investment, the tech investment in the next, say, 5 years or so?
See, let me give you some information, statistics, what is there in the RFP. Our GTV volumes has compounded at almost 60% over the last 3 years.
This is gross transaction value.
Gross transaction value. The number of transactions have also compounded at 50%. The number of merchants which have come and signed up with us, banks and financial institutions, fintechs, which have partnered with us, that has grown by 30% over the last 3 years. Now, if that trend has to continue, we'll have to continue to invest when it comes to technology, product creation, infrastructure. So a certain component of this primary that we are raising will go towards technology. The second thing what we have seen is almost 15% of our revenues is now coming out of global markets, and that revenues has grown at 70% plus over the last 3 years at a compounding level. What we are getting to see is the fintech that you are producing in India has got relevance in global markets. We think we can win in the global markets. Hence, we want to invest into capabilities in terms of building out presence in global market, building out platforms in global markets. So certain component will go to that. And then the last component out there is what is related to any potential acquisitions which might come our way. We don't have any target in place yet, but we wanted to keep an enabling provision for acquisition. About 25% of this primary component that we are raising, we will actually use it to retire debt. We are a net debt positive company.
Amrish, coming to the cash generation point that you made earlier, when you're looking at your cash flow positive status, that's come in about a couple of years ago. You've had your first quarterly profit only in June. You've had that adjusted EBITDA improvement. I'm just trying to understand from you, I know you can't give me specific numbers, but going ahead, what does that trend look like, on the financial spaces?
So in FY24, our adjusted EBITDA was at about 155 crores. In FY25, that came in at about 355 crores. If you can see, the adjusted EBITDA has grown by more than 100% between FY24 and FY25. And just in the first quarter of FY26, that number is at about 120 crores. So if you see, there's a very clear trend in adjusted EBITDA improvement. Now, between the adjusted EBITDA and the PBT and a PAT, there are two major components. One is the ESOP cost, other is related to amortization. When it comes to the ESOP cost, we've taken a principal position which says that ESOPs will not be delivered at a deep discounted or at a zero level. We will say there will be a small discount to the FMV of our stock. What that does is it means that there is lesser impact on the P&L especially between adjusted EBITDA and the PAT level. So we have seen an improvement in our PAT numbers also, starting from about 340 crore-ish of negative to this quarter where we've actually turned positive on the PAT side. Honestly, I would have to say that that trend, we feel very comfortable with where that trend is going.
Okay, got that. Among your other expense areas, there's one on the procurement cost point as well. We've seen events where foreign imports of key physical infrastructure that has seen some amount of issues, right? Is that something that worries you at all, or do you think that your supply chain is tweaked enough to maintain any kind of issues that might come up?
In fact, our supply chain, because we are largely a tech and a software company, and we almost, eat what we build, we are actually building out most of the capabilities within our company. We are very, very hardware agnostic as a company. We really are not wedded to a certain platform. We use cloud very aggressively in our business. So in terms of procurement, I don't see that to be a big concern. It's really about how much we can code and what technology that we build. Understood. That's the central focus.
Understood. Coming to the payments ecosystem that exists at this point in time, right? Like, so, for example, UPI, which is one of touted as the biggest development in consumer payments, still is heavily subsidized by the government. You've got cards which as a payment mechanism has seen some amount of impact because of the popularity of UPI. Keeping these things in mind, and because you are in the physical payment space as well as a prominent player, what do you see the ecosystem developing into? Do you think that at some point in time, we need to call a spade and say that this is the cost associated with making payments, and we need to recover that cost from the customer or from the merchant, whoever?
So first of all, the way we've built our company is we've actually said that, look, the payment transaction which runs on our infrastructure, may that be a card transaction or UPI transaction, loyalty, rewards, installment payment, that's completely incidental. What we are saying is, once we have built out the right technologies, merchants and banks will pay us for those capabilities that we have built. and the point of presence that we have created across the country, merchants will also pay us for those services out there. What we have tried to stay away for the longest period of time is to play the entire MDR game. And as you know, those are the ones which have been generally under pressure over the last few years' time. But one of the reasons why the government has done that is because government believes that if you can make payment system very accessible to the merchant community, then there will be growth on the payment side. And to be honest, all data seems to be showing that that is right. Consumers have adopted to digital payments, merchants have adopted to digital payments, and I think the government has been proved correct in that process. Reserve Bank of India, on the other hand, has a completely different mandate where they are saying, is it secure? It is easy for the consumers to operate. Is the consumer aware of everything which is happening out there? Again, some of the steps which the Reserve Bank of India have taken has actually allowed payment systems to accelerate in the company. We, on the other hand, because we took this tech-first approach and basically charging for the technology services that we provide out there, we have been able to create a business which is now operating at a 20% EBITDA margin.
But do you think that maybe if you were to go for more frugal technologies like UPI, where even the technology or the consumer-facing piece of that entire value chain is a sticker, right? Essentially, do you think that has an impact on your business?
See, now, for example, we are actually getting to see a very, very unique trend. So as I have told you, we are present in all the large top 5 retailers of the country. We are in the top 5 hotels also in the country. We are actually getting to see now 50% plus transactions are going on UPI. Now, while those transactions have increased, as I told you, we make money on the software services stack. We make money by the transaction. We make, in some cases, we make money depending on what the transaction is, on the value of it. So growth in UPI has only helped us in terms of our revenue economics.
Okay. Interestingly, last night I was out for a dinner with my wife, and it was a fairly good restaurant. And the most favored payment across tables was the sticker on that card. So
absolutely,
you know, that's where the question came from.
Yeah.
Okay, last couple of questions. I wanted to try and understand from you the regulatory landscape that we are in at this point in time, where you pointed out that is it secure, is it efficient, is it something that gives the customer enough confidence to use you know, any kind of payments mechanism, non-cash payment mechanisms. Is the ecosystem, however, too tight for players like yourself when it comes to, because you as a service provider have to focus on the merchant and your bottom line. But now you have to worry about the guy who's paying as well. Does that impact you at all?
I mean, let me give you one very interesting statistic. NPCI was created by the Act of Parliament. Yeah. NPCI is owned by most of the banks. Yeah. Reserve Bank of India has an innovation hub called RBIH. Yes. We had Narendra Modi ji, our Honorable Prime Minister, attend the Global Fintech Festival twice in the last 2 years' time. Yes. Let me tell you one thing. The regulator, NPCI, the government is super supportive to what is happening in the fintech ecosystem out there. Very rarely, anywhere in the world, you get to see the highways have been set up by government or government-like bodies, and people like us who are supposed to build applications on top of that, our job becomes super easy where we are just riding the cars on that highway. No other country actually gives you that kind of infrastructure. I'd rather be in this environment where highways are being provided by government-like bodies, and then our job as fintech founders are just to build applications on top of that. So it's a very, very conducive environment that we live in.
I'll take that analogy a little further. In India, the other issue is that whatever you're driving on those highways, you can't tell the rest of the world. You have to hold that information in India as well. Does that cause a problem at all?
That's a positive. That's a positive. So what happens is, because we are an Indian company, very, very homegrown in our approach, we have a natural advantage as we go and speak to anybody, because our technologies are already on the ground out here. Sure. Now, when we go global, we actually face the same situations in many countries where we are required to adhere to those global standards and their regulatory environments. And we are totally doing that in many countries across Southeast Asia, Middle East, and Africa today. We are present in about 20 countries across these geographies.
I want to close this conversation with one last question. What is your message to investors? Why should they come and buy into Pine Labs?
I think the one simple thing that I'm going to point out is, fintech which has been created in India is ahead of anywhere else in the world. So while we continue to grow our fintech capabilities in India, I think there's a big opportunity which exists for fintech outside of the Indian market. If I tell somebody that, AI is my strength, they may or may not believe me. But if I tell somebody that fintech is my strength, everybody believes us around the world. What UPI has done allows us to communicate that we are ahead of the curve when it comes to fintech. And we at Pine Labs are one of those companies which is grabbing this opportunity both in India and in global markets.